Hey there! Welcome back to Zero to Financial Freedom, where we break down finance in the simplest way possible. Today, we're going to talk about something many beginners get confused about. What's the difference between a stock and an ETF, and which one might be right for you? If you're just starting out with investing, this video is for you. Let's dive in. Let's start with stocks. A stock represents ownership in a single company. When you buy a stock, you're essentially buying a small slice or share of that company. For example, if you buy a share of Apple, you own a tiny part of Apple Inc. You make money when the stock price goes up or when the company pays dividends. Pros: higher potential returns if the company does well. You're investing directly in a business you believe in. Cons: higher risk if that one company performs poorly, less diversification. Now let's talk about ETFs, or exchange-traded funds. An ETF is like a basket of stocks, all bundled together. Instead of buying just one company, you're investing in many companies at once. For example, the S&P 500 ETF holds shares of 500 top U.S. companies, from Apple and Amazon to Coca-Cola and JP Morgan. Pros: built-in diversification, lower risk than buying a single stock, easy to trade like regular stocks. Cons: slightly lower returns compared to the best performing stocks. You pay a small annual fee called the expense ratio. Let's compare the two, stocks and ETFs, so you can clearly understand how they differ. First, what do you own? With a stock, you own a piece of one single company. With an ETF, you own a mix of multiple companies or assets bundled together. Next, the risk level. Stocks carry higher risk because your money is tied to just one company's performance. ETFs carry lower risk because they're diversified, meaning your investment is spread across many companies. What about the cost to invest? Stocks usually have no ongoing fees, but because you're relying on one company, they can be riskier. ETFs often have a small annual fee called an expense ratio in exchange for that built-in diversification. And who are they best suited for? Stocks are typically better for experienced, hands-on investors who like to research individual companies. ETFs are great for beginners or passive investors looking for long-term, steady growth. So, if you're confident in a company and want to take a bet on it, a stock could be the right move. But if you're just getting started and want to reduce your risk, ETFs are a safer, smarter way to begin growing your wealth. So, what should you choose? Stocks or ETFs? It depends on your goals, your risk tolerance, and how involved you want to be in managing your investments. Many smart investors actually use both, buying individual stocks they believe in, while using ETFs for stable, long-term growth. If you found this breakdown helpful, don't forget to like, subscribe, and hit the notification bell so you don't miss more simple, beginner-friendly finance content from Zero to Financial Freedom. Got questions about stocks versus ETFs? Drop them in the comments below. Until next time, invest smart, stay consistent, and keep moving toward your financial freedom.